Hi guys, welcome to BJ Spikes. Today's topic is on how to grow your money using personal finance for beginners. Let's get started. Why is personal finance important? This is an area which is mostly neglected by many. In order to lead a financially healthy life, you need to focus on your personal finance. By the end of this video, you would be having a detailed overview on how to manage your finance. Number 1. Manage your money. You may have many financial goals in your mind, like buying a vehicle or the latest smartphone or wealth accumulation. In all these situations, you need money. But where it'll come from? You got to have your savings. Saving money helps you avoid falling in debt traps. Not only this, but systematic saving on a regular basis can make you rich. You may achieve your financial goals in a timely manner. Now you might be wondering how to save, and even more important, how much to save. As soon as you get your salary, start putting it under various heads. These heads can be expenses, EMIs, investments, and savings. Ensure that you save 10% of your income every month. It can be that simple, but don't put it in a piggy bank. Idle money in a piggy bank doesn't grow. Even the saving bank account may not fetch higher returns. Instead, you may invest this amount in a liquid fund. The liquid fund is a type of a debt fund which invests money in fixed income generating instruments like FDs, bonds, etc. Save every month on a continued basis. Number 2, expense management. If you are living paycheck to paycheck and find yourself struggling for money even before the month ends, then chances are you are living way beyond your means. Maybe there are a lot of unplanned expenses that might be leaving you with no money for the necessities. But there's a way out of this. Try making a budget. Unless you have a budget before your eyes, you won't be able to control your cash flows. A budget simply shows how much money you have coming in and how much those funds are being spent. Start by categorizing your expenses into fixed and variable, urgent and non-urgent, necessities and luxury, avoidable and unavoidable. In this way, you will create a full inventory of expenses in front of you. The more you convert things from abstract to physical, the better you will get a hold of them. You can create a hierarchy of needs and decide which one to address first. It's all about prioritizing. You need to accept that you have got limited resources and unlimited wants. But you have to manage your resources. The sooner you accept this fact, the better you can control your impulse towards avoidable expenditure. Number 3, maintain your own book of records. Having a personal balance sheet helps to know what you own and what you owe. It's a pretty powerful tool to take your finances to the next level. It's a statement wherein you can jot down your assets and liabilities. The difference between your assets and liabilities show your personal net worth. Before getting started, pull together your bank account statements and other proof of the liabilities. Then list down your assets like the bank balance, all investment, home value, and value of other assets. Take a sum of all the assets to arrive at the total value of your assets. Afterwards, list down your liabilities like the car loan, home loan, credit card balances, and remaining balances in other loans. The sum of all the liabilities will show the value of the money you owe. Number 4, deal with surplus cash wisely. How you deal with your surplus cash determines your future. When you don't have a plan, you are likely going to indulge in overspending. This money could have been used to make you financially self sufficient. In the backdrop of inflation, everything is going to be costlier with each passing year. If you don't invest, your money won't grow to bridge the inflationary gap. You might have to work beyond your 70s to pay your bills. It's like not being able to retire forever. Investing can be a great way to channelize the extra cash and counter inflation. It can be used to grow wealth and divert it to goal accomplishment. The earlier you start investing, the better. Investing need not be a difficult and boring task. Perceive it as a bridge between where you are and where you want to be. Start with identifying goals like buying a car or planning for retirement. Categorize those goals into short term and long term goals. Goals that can be achieved within 1 to 3 years are essentially short term goals. Goals that need a horizon of 3 to 5 years are called medium term goals. Goals that require more than 5 years to achieve are long term goals. Then identify your risk appetite, that is, the degree to which you are comfortable with a fall in the value of your investment. If you can digest, say, a 20% fall in the value of your investment, you are a high risk seeker. Else, categorize yourself as a risk averse person. After identifying your goals and risk appetite, you can conveniently select the investment you want to make. A risk seeker may go for a diverse equity fund. Conversely, a risk averse would choose a short term investment like the liquid fund or a balance fund. Number 5. Create your financial portfolio. Constructing your investment portfolio is an achievement in itself. After all, it is your first step towards wealth accumulation. Building a portfolio involves distributing your investment among asset class like equity, debt, and cash. It is known as asset allocation. Although equity is the best tax efficient and inflation countering vehicle, however, putting all your money in equity isn't a prudent move. You need to diversify the sums that are to be allocated in each asset class as per your investment goals. It is always wiser to be a long term investor in order to accumulate greater corpus. Your investment horizon would ideally be around 10 to 15 years. Once you have constructed a portfolio, you need to rebalance it periodically to keep the portfolio risk within expected limits. This is relevant from standpoint of market fluctuations. At the very outset, you must decide the time intervals you want to rebalance your portfolio. You can do it in every 6 months or in an year. Number 6, retirement planning. Planning for retirement has become all the more important today than it was few decades ago. There are reasons behind it. Due to increased life expectancy, you are going to live longer than your previous generations. Owing to sedentary lifestyle, you are more vulnerable to ailments like diabetes, hypertension, and heart attacks. Healthcare costs are increasing with each passing year. Lastly, in absence of social security net, you need to have your own funds to tackle all these issues. Like many others, you might be thinking that it's too early to start planning now. In this way, your retirement planning may get postponed forever. In fact, improper retirement planning can never let you retire from your job. What you don't know is that the earlier you start, the richer you retire. It happens due to the magic of compounding. In this way, you can even retire early and lead a hassle free life. While planning for retirement, you need to clarify a few points like deciding an age at which you want to retire, along with the estimated amount of money as corpus you need for every month to meet your post retirement expenses. Number 7, debt management. Lack of debt management may eat up a major part of your paycheck. You may end up borrowing fresh loans to pay off older loans. If it gets out of control, then you may fall in vicious debt trap. Your critical life goals may get sidelined and even your retirement may get delayed. However, strategizing your debt payment may keep you away from such troubles. All you need is being informed about how much you owe to whom and chalk out a schedule to pay them off. In case you have a lot of debt to shoulder, start paying off the most expensive one. In fact, the credit card has been regarded as most expensive form of debt. As soon as your salary gets credited each month, pay off your credit card balance in full. Don't fall for the lure of paying off the minimum balance. Even before you know, the interest will spiral up to eat out all your savings. Make it a point to use credit card only in case of emergency. Always keep debt as the last resort as far as possible. Make down payments for all your purchases on time. Number 8. Manage your risks. You need to realize that your life and property are vulnerable to risk. These risks can lead to loss of income and put you and your dependents in a financial jeopardy. Just like investing is essential for wealth accumulation, insuring is essential for wealth preservation. However, investing and insurance are two separate things which most individuals don't understand. Investment is for your wealth accumulation and insurance is for life. Number 9. Maintain a record of your finance. Maintain a record of all the documents which you owe, all the insurance you maintain, your PPF account information, your DMAT account information in a password protected file and share it either with your spouse or with your parents, as it would help them manage the finance in case of any emergency situation. Number 10. Plan your taxes. In tax planning, you analyze your finances from a tax efficiency point of view so as to plan these in the most optimized manner. You attempt to take advantage of your various tax exemptions, deductions, and benefits so as to reduce your tax liability at the end of the financial year. Even though tax planning is very much legitimate in nature, you need to ensure that you don't indulge in tax evasion or tax avoidance. Hope you got some insights on how to grow your money using personal finance. If you like our work, then please comment below. Subscribe to our channel VJ Spikes and share our video to your loved ones. You can also follow us on Telegram, link given in the description box. Here we share many unique ideas on investment and personal finance. Thank you.